Hey, this is Chris Goff, and in this training video in REIPro, we're going to talk about how to seller finance it from the owner and turn around and seller finance it to a new buyer. We'll scroll down, and if you've seen some of the other seller finance training videos here, you're going to see that I'm keeping the same numbers on this property at 415 is the after repaired value, and that's assuming that we're in tip-top shape. This property is not, and that's why we're getting it at a good number at 285. You can see repair cost at $48,000 with a 10% hedge expense, which is nothing more than a buffer I like to add to the repair cost in case you miss something during the inspection. Repair period of 2 months. Other costs are going to be monthly holding cost. And again, if you just click that little button there, you can really define this to exactly what that number is. I'm just throwing out a hard number here. You can do the exact same thing with closing cost as well. Property insurance $1,100, taxes $4,500, HOA dues $200. So here we're getting financing with the owner. So instead of you going to the bank, putting down 20%, putting it on your credit report, we're having the owner actually finance this for us. So loan amount at $285. And again, this is nothing more than just paperwork that we're talking about. It's not like they're giving us the money and then we're repaying it. So $285 with $5,000 down. And the reason why I go low on this is because the property needs a lot of repairs, which is a great negotiation tactic you can use to get in with a lower down payment. At 4% interest, we're going to amortize this over 30 years with a 5-year balloon payment. So meaning I'm going to make payments for up to 5 years, and then I would either need to refinance it or sell the property in order to cash the seller out. Okay, so we could sell it tomorrow or we could sell it up to 5 years. Now let's look at the new buyer. So we're going to seller finance this property out. And of course, if I fix this property up, put it in tip-top shape, I'm going to sell it for as much as I can, especially if we're financing it for the buyer. I'm going to require a $25,000 down payment. Again, there's no formula on this. I tried to figure out, hey, based on this price, how much could I get down? So I know 10% would be $41,000. So this is going to be under 10%, which I think is a very manageable number. We're going to do 6% interest. Remember, we're paying 4. We're going to charge 6. We're going to amortize that over 30 years, but with a 3-year balloon. So remember, I have 5 years with the seller, but I'm only going to go 3 years with the new buyer. If they can't buy at the end of 3 years, what could I do? I could extend it another year or up to another 2 years. I could find somebody else for the property. Exit strategies galore because I could rent it, I could sell it, I could sell or finance it, I could lease option. I still have 2 more years on the term. Ideally, yes, we want them to cash us out because we're going to make a lot more money on the back end sales price. So ideally, yes, let's get these people cashed out. Insurance, taxes, and HOA dues are just going to carry over. So that's a cost that they're going to pick up. So although I'm agreeing to pay for it over here, my new buyer on the other side is actually paying that number. You can see the analysis as we go down through this to find out my total profit on this property. And it's a lot. Keep in mind, we got a good deal. It needed work. It doesn't go on our credit report. The seller's happy they're receiving payments. And if the buyer cashes me out within the 3 years, the seller's even going to be happier because they're thinking they're going to have to wait 5 years. So they're going to be happy. It's a total win-win. As far as the new buyer, they're buying a house without going to the bank. It doesn't mean we're not doing a credit check. Doesn't mean we're not having them work with our mortgage broker to make sure they can cash us out in 3 years. But the great thing for the buyer is that the property is going to be in their name. And if it's in their name, then it's a refinance, which is a lot easier to get the loan. It's a great investment opportunity. I mean, this would obviously be one of those ones that I would call a home run. So, but as you can see, it's very profitable and it only takes one to do very well. So definitely save this one because this would be a great deal. Anyways, hope those tips helped and look forward to seeing you on the next training video.